Oil prices snap 3-day winning streak. Energy market update. Imagine a world where the price of oil can fluctuate wildly, leaving investors and consumers on edge. This is the reality we face today, and it's about to get even more intense. The latest market talks covering energy and utilities have just been released, and they're packed with insights that will make you wonder what's next for the oil market. Published exclusively on Dow Jones Newswires at 4:20 ET, 12:20 ET, and 16:50 ET. These talks are a must-read for anyone looking to stay ahead of the curve. But here's where it gets interesting. The oil futures market has just snapped a 3-day winning streak, and it's all because of the looming U.S. tariff deadline and the upcoming OPEC Plus meeting. This meeting is expected to bring another large output increase for September, which has many experts predicting a significant impact on oil prices. And this is the part most people miss. Despite the current gains, the fundamentals for oil are actually weakening. According to Neil Crosby of Sparta Commodities, if it's business as usual, the fundamentals for oil should weaken. He explains that a lot of people are expecting weaker demand going forward. OPEC are due to export probably a lot more oil after summer, and with those two things combined, you should start to see more of these inventory builds. But what does this mean for the average consumer? It means that the price of oil could be in for a wild ride, with many factors contributing to its volatility. The recent rash of U.S. trade deals and threats of Russia sanctions have oil prices on track for solid weekly gains, but if the sanctions are avoided, it could be a different story. As the market continues to evolve, one thing is certain: the price of oil will be closely watched by investors and consumers alike. WTI settled down 1.1% at $69.26 a barrel, while September Brent went off the board at $72.53, down 1%. So what's next for the oil market? Will the OPEC Plus meeting bring about a significant increase in output? And how will the U.S. tariff deadline impact prices? These are the questions on everyone's mind, and it's time to weigh in. Do you think the oil market is due for a correction, or will it continue to rise? Share your thoughts in the comments below, and don't forget to check out our further reading section for more insights into the world of energy and utilities. Copyright 2025, Dow Jones Company, Inc., all rights reserved. Oil prices drop amid OPEC Plus supply concerns and U.S. jobs data. Shockwaves hit the oil markets as prices tumbled by $2 a barrel, stirring up fresh debate over what's really driving the volatility. Is it OPEC Plus hinting at turning on the production taps, weaker signals from the U.S. economy, or the latest round of trade war maneuvers? The real answer might be more tangled than most headlines suggest, and here's why. By Friday's close, the international Brent crude benchmark had dropped to $69.67 per barrel, falling by $2.03, 2.83%, while the U.S. West Texas Intermediate WTI benchmark finished at $67.33, down $1.93, 2.79%. Yet for all the single-day drama, Brent ended the week up almost 6%, and WTI edged up by 6.29%, proof that the market remains on a knife edge, with bulls and bears squaring off day by day. So, what happened? Let's break it down for those new to the oil game. Several insiders with knowledge of the talks report that OPEC and its allies, often called OPEC Plus, are deep into discussions to potentially hike oil production by 548,000 barrels per day as soon as September. There's still room for surprises, though, with some sources cautioning that the actual increase could be smaller as the group hashes things out. Here's where it gets controversial. Every time OPEC Plus hints at pumping out more oil, traders worry about a flood of new supply dragging down prices. But the flip side? If they hold back, there's always the fear of shortages and price spikes. There's rarely consensus in this world, just endless debate. But OPEC Plus isn't the only player throwing curveballs. On the demand side, traders took a hard look at the latest U.S. jobs data. Rather than the robust hiring spree economists expected, the Labor Department reported just 73,000 new jobs in July, nudging the unemployment rate from 4.1% to 4.2%. Not exactly a sign that American industry or consumers are about to go on a spending spree. And if folks aren't working, they probably aren't driving or consuming as much. Phil Flynn of Price Futures Group summed up the frustration in the market by pointing a finger at both the White House and central bankers. Was it President Trump's new tariffs shaking things up? Or did the Federal Reserve make a misstep by pausing on rate hikes? The Fed's midweek decision not to lift rates was panned by Trump and other Republicans, adding more uncertainty about the direction of the U.S. economy. And this is the part most people miss. Looming just overhead are newly announced U.S. tariffs that are about to reshape trade flows starting August 1st. Trump's executive order slapped tariffs from 10% to a whopping 41% on imports from countries that haven't inked deals with the U.S. A list that includes major players like Canada, India, and Taiwan. Partners such as the EU, South Korea, Japan, and the UK managed to sidestep this, securing agreements just in time. According to Suvro Sarkar at DBS Bank, much of the recent uptick in oil prices can be traced to markets finally seeing some clarity in how these trade deals shaped up, though a few big economies, notably China and India, remain in the crosshairs. But there's more. Trump's threat to hit buyers of Russian oil with 100% secondary tariffs is creating ripples. The threat is part of a push to starve Russia of oil revenues during its ongoing conflict with Ukraine, and it raises tough questions. Could such tariffs knock out as much as 2.75 million barrels per day of Russian exports to major consumers like China and India? Analysts at J.P. Morgan think that's a real possibility. With China and India being the world's number 2 and number 3 crude buyers, any fallout here could dramatically reshape the global energy landscape. Now here's the question stirring the most debate. Are these aggressive U.S. tactics and tariffs and sanctions really stabilizing the oil market? Or are they setting us up for even bigger shocks ahead? Should OPEC Plus open the taps now, or stay cautious with all this uncertainty swirling? What do you think? Is this all just the ebb and flow of an interconnected market? Or could we be heading for a seismic shift in how oil is traded and priced? Sound off with your take. Do you back the recent moves, or do you see trouble brewing? Let the debate begin. Trump's tariff ultimatum fuels oil price volatility. Imagine this. Oil prices skyrocketing and then dipping unpredictably, all because of a single political move. That's exactly what happened this week, as crude oil prices experienced a roller coaster ride, influenced by a mix of trade diplomacy triumphs, tightening supply chains, and escalating geopolitical tensions. But here's where it gets controversial. A sudden pullback on Thursday trimmed the week's gains, as traders nervously anticipated the repercussions of U.S. trade policies. By Thursday's market close, light crude oil futures settled at $69.26 per barrel, marking a significant increase of $4.10, or 6.29% for the week. The week's rally began with a bang on Monday, thanks to a groundbreaking U.S.-EU trade agreement. This deal effectively removed the specter of widespread tariffs and shifted the market's focus to long-term energy collaboration. The European Union committed to buying a staggering $750 billion in U.S. energy products over the next 3 years, a move widely interpreted as a robust boost for transatlantic energy demand. Additionally, the EU pledged $600 billion in investments in the U.S., further reinforcing confidence in the stability of global trade. Optimism continued to soar into Tuesday as the U.S. and China resumed their trade negotiations in Stockholm. These talks hinted at a possible resolution to the long-standing trade disputes between the world's two economic powerhouses. Such an outcome could significantly enhance global trade flows and bolster oil demand across various sectors, including logistics, shipping, and industrial activities. Midweek, the spotlight shifted to escalating geopolitical risks, which dramatically increased the market's risk premium. Former President Donald Trump set a 10 to 12-day deadline. Community membership free. Global Energy Alert. $697 per year. Get the latest energy news before it hits the mainstream media. Access top-notch analysis from seasoned industry experts. Discover exclusive investment opportunities. Understand complex data with easy-to-digest breakdowns. Gain geopolitical insights from our extensive network of over 600 operatives. Enjoy a risk-free 30-day money-back guarantee. And this is the part most people miss. How do these geopolitical maneuvers and trade agreements truly impact the global oil market? Do you think Trump's tariff ultimatum was a strategic move or a risky gamble? Share your thoughts in the comments below.